Morning, everyone, and welcome to our monthly market session, February's edition. I am your host and local market expert, Paul Nalabandian. I'm also an attorney licensed in the District of Columbia, realtor licensed in DC, Maryland, and Virginia, and a team leader on Fulcrum Residential, one of the top real estate teams in the country, along with my colleague Temi. And we have all of your DMV real estate needs covered. We are proudly affiliated with Keller Williams Capital Properties, where I'm also proud to be serving on the Agent Leadership Council for the 6th year in a row. We are about to get started. Just a couple of things first. Temi, great to have you with us. Temi with the good. Would you like to introduce yourself?
Yes, I'm Temi with the good hair.
All
Excited
right,
to be here this morning.
Me too. There's a lot that has been going on, a lot of really interesting stuff in the market. And I would love to hear. So I know where people usually get on a couple of minutes late. We're about to do coffee of the day, but for those of you who are on here already, would love to hear where you are from. If you're an agent, where you practice, if you are a consumer thinking about buying or selling. Mention if you have any particular real estate questions or concerns. I would also love to hear, for anyone on here, anyone who jumps on or watching later in the video, if you were an agent and had a property under contract in December that didn't close in January, I would like to know why, because there's some really interesting stuff that went on. I have some suspicions, but the data doesn't tell that story. So it's really the boots on the ground kind of information that only you all can provide. So would love to hear. All right, it is time for the most anticipated tradition of the session, coffee of the day, brought to you by Tyrone Voiles. He is our proud sponsor of Coffee of the Day. Ty, the sponsorship check hasn't arrived yet. I keep checking the mail, so we'll have to look at that. Anyways, this is from S&W Craft Roasting. They are out of Indiana. It's really neat, kind of a mom and pop shop. They do it on the side, but source some incredible greens. This one is from Colombia. Jairo, Arcila, a rather famous producer. And this one is a pink Bourbon rose honey co-ferment. So it was fermented with rose petals, honey processed. It is a really beautiful cup of coffee. So this should keep me energized and going for the session. All right, let's jump in. We are going to, good morning, Maggie. Morning, Virginia. Always great to have our true expert economist on here. Good morning, Harmony. Mark, great to have you. We'll be drawing on your expertise with some mortgage questions. Mark is our wonderful lender partner with Envoy. Great to have you, Maggie and Blue Jay Properties. Okay, jumping forward, we're going to follow the same format that we typically do. We were going to start looking at mortgage rates in the economy. We look at the economy because it impacts mortgage rates. We'll run through where rates are and then the major components of the economy that are affecting those rates, where they might be headed. Then we are going to look at what's happening locally. Things are diverging a bit locally since the new administration came into power with the efforts of DOGE and the downsizing of the federal government. We have been disproportionately impacted, and the DMV economy is taking a bit of a hit. From there, we are going to go into real estate specific data, spend the second half of the portion covering that. We are going to start by looking at the most recently reported month, which is January 2026, and then we're going to look at the weekly data. This month, kind of like I did last month, we're going to look at the week ending February 1st, which I know only has one day in February. Then we're going to look at the first week of February, the second week of February, because there are a lot of peculiar things that have been happening in the market. So I wanted to make sure we were all up to date in what is going on, at least as recent as we can get, and try to parse and figure out where things are headed, because it's a bit unusual and confusing. So, all right. Whoops. Little cheat. Where are mortgage rates at? And this is where it's great to have real world information of what people are getting for their clients. So anyone on here who's had a client lock recently, if you could let us know what rate they locked at, also let us know whether it's fee simple or condo, and then conventional, FHA, VA, or ARM. Gonna take a quick peek. These as of last night, and I don't think they've reported yet for today. Oh, sorry. Just yep. Go ahead.
As of yesterday, 6% conventional.
Okay, nice. And that's kind of right around where I would expect. So you can see here that rates have come down right into the 6% range. But when we met last month, a few days before, they had dropped right around to 6 and then popped up just a bit. They have since come down again and are right. Mortgage News Daily is reporting about 605. Mark is saying 5875, 6125 fee simple. Nice. That's great. It's wonderful to see rates in the fives again. And I want to note this. I mentioned this last month, but it's even more so true this month. So 30-year rates are down about 16 bips from exactly when we met last month. And they've now been in, I said last month, this was the first time since rates spiked in 2022 when we have had mortgage rates in right around that 6 to 6.3 band for a meaningful length of time. They had dropped down there in, I think it was September 24, February of 23, had dropped down there, but popped back up again. So this is the first time. Last month it was even true. This is the first time where they had been in that range for a meaningful length of time. Now we've been another month in that range. So this is really the longest prolonged period of lower mortgage rates we have had since 2022. Love the chiming in. Darren saying about hopefully show Maryland data separate from DC. So when you're talking about mortgage rates, but mortgage rates are agnostic largely as to geographic area. But when we talk about real estate specific data, we are absolutely going to talk about Maryland. We're going to break it down into county level. And then also when we're talking about unemployment, we're also going to look at Maryland and DC. So just kind of meaningful, like I said, the most prolonged period of lower mortgage rates we've had. Now here, what I found interesting, you'll see I bolded it there, is that Mortgage News Daily is reporting an ARM products. Their survey is coming back. Average survey rate on the ARM product is 537, which is the first time we've had a real meaningful large gap between 30-year conventional and the ARM. I spoke with Mark yesterday, spoke with a couple of other lenders. I'm not seeing that rate in the real world. I think to get that rate, you will probably have to go to a credit union or some other entity that is using an in-house product. So right now, ARMs that are being packaged, you're not seeing anywhere near that rate, maybe about 25 bips lower, not necessarily enough to make it worth getting the ARM and locking yourself into a refi, essentially. So that's another thing, though. If anyone has gotten an ARM lately that is in this range of 537, let us know where. Okay, how are people feeling about the economy? A lot of really interesting stuff happening in the economy. Oh, also wanted to mention that I saw that Rocket is advertising a 5.5 jumbo, which is significantly lower than this. Whether anyone can get that in the real world, I don't know. I know also that Mark has actually some decent rates on ARMs for jumbos, and you can get some better jumbo rates out there than is showing here. Okay, how are people feeling about the economy? And while you think about that and maybe chime in, if you join us every month, if this is not your first time here, you can just zone out, grab your own cup of coffee, take a little break for the next 30, 40 seconds. But for anyone who is new or watching for the first time on video, just want to run through really quickly why I talk about the economy. And I talk about the economy because that is what impacts mortgage rates. Most mortgages are packaged into mortgage-backed securities where they have to compete with other bond products and treasuries on the open market for investor dollars. So they have to be competitive. That's why there's usually a spread between mortgage rates and the 10-year treasury, because they're kind of competing for the same universe of investor. And so how the bond market is doing is really what determines where mortgage rates are at, unless it's like an in-house product. Like I said, sometimes you'll have loss leaders, people doing things for their clients. That's why in-house products can vary more from overall rates. But for general conforming mortgages, they're going to be packaged into mortgage-backed securities, compete on the bond market. And what determines how the bond market is doing? Well, you have the overall economy, which is what we all talk about: retail sales, consumer spending, manufacturing, employment, all of that. And then you have the Federal Reserve, who they are both impacted by and impact the economy. And they do that through setting the federal funds rate at their monthly meetings. They can also do QE and QT, where they either put money into the economy or pull money out of the economy. Kind of the most famous example of this is during the pandemic when they were doing massive QE, where they were buying mortgage-backed securities and U.S. Treasuries, something on the order. They were buying $120 billion of these a month, I think, in total over the pandemic period. They bought something like $1.5 trillion of mortgage-backed securities and maybe $2.5 trillion of Treasury. So a massive amount. That's why mortgage rates got artificially low. And then more recently, more impactful, you're having tariffs and trade policy. All of these things taken together influence the bond market. Overly simplified, but basically, if inflation is low and the economy is sputtering, that's usually the best formula for lower mortgage rates, because when you have times of economic uncertainty, money floods into the bond market. If you have more demand in the bond market, then you don't have to offer as high of a return on that investment. And that's kind of overly simplified, but with enough detail, hopefully, to be helpful of where mortgage rates are at. For those in the deck, also kind of run through what I just said. All right, so let's look at GDP. The advanced estimate was updated, kind of unusual. Usually you have the first estimate, the second, and the third, or the final first, sometimes called the advance. So this wasn't the second estimate, but it was an updated first estimate, which sometimes happened, but just a little unusual. And so they bumped up Q3 estimate up to 4.4. And if this holds, it'll be the greatest quarterly growth in 2 years. And in the past 4 years, we've only had one quarter with GDP above 4%. So the advanced estimate of Q4 is going to be released on Friday. So we'll be getting some additional data. But by all accounts, Q3 was a very vibrant and booming quarter. One thing kind of want to mention, the trade policy absolutely affected that. That's when tariffs were really trying to take a bite, and don't need to go into a ton of detail, but essentially, the more imports you have, the lower GDP is, all things being equal, because it's canceled out. Quick example, if someone buys a $2,000 TV that was manufactured domestically, it counts for $2,000 in consumer spending and then also counts for domestic production. If someone buys a $2,000 TV that was manufactured overseas, it counts as $2,000 for consumer spending, but then $2,000 is taken away because it was imported. So essentially it nets at zero. And so that's why when you had a shrinking trade deficit, you saw the GDP increasing, and a chunk of that was just a reflection of what was happening with trade. Okay, now the Federal Reserve of Atlanta's GDP Now model, right now they are projecting Q4 GDP at 3.6. This is meaningful because as of just a few days ago, they were projecting 3.7. And when we met last month, they were projecting 5.4. Now, I've been seeing a lot of things in the economy that indicated that the Q4 was not coming in at 5.4. And Atlanta GDP is always at the higher end. I was expecting it to come down. And you can see in the chart there that they have now come down. They're still at the higher end of where most people are projecting. The New York Fed forecast has held steady. Mentioned last month, the New York Fed is forecasting 2.7 growth for Q4, and that's the same thing they are projecting now. Now, how do people feel in general? If you would see these numbers, if you knew nothing else, but somebody was saying Q3 GDP came in at 4.443, Q4 came in at 3.6. How's the economy doing? Most people would say, oh, if that's all they knew, the economy is doing wonderfully. Wow, we are really humming along. Everything must be wonderful. Well, if you talk to people, that's not what a lot of people are saying. There's segments of the economy, segments of the populace that are doing wonderfully. But overall, a lot of people are feeling some pain. And so just want to touch on this a little. And but also, like, what are people hearing from their clients? Does anyone have people who were thinking about buying and have now pulled back because they're uncertain about their job or uncertain about the future? Would love to get that information. If anyone wants to comment in the chat or watching later on video, drop it in the comments. So Conference Board Consumer Confidence Index dropped again in January, 6th straight month of declining consumer confidence. And it fell pretty sharply in January. So it dropped to its lowest point since 2014. And this is even lower than the pandemic depths. University of Michigan Consumer Survey, not the same. So just want to present like a full picture here. University of Michigan is also very respected. These are probably the two most respected consumer surveys. They were essentially even from January and up from their recent low, but they're down more than 10% over year over year. So it's like they haven't had such a decline recently, but they're still reporting that that most people are a little concerned about the economy, and that's what we're seeing in the chat as well. Yeah, Maggie saying buyer activity is still there. People are more payment sensitive. That makes sense. Mark saying people are cautious, and yeah. And Christina mentions that government workers are on hold, and I have that too. Like a lot of government workers are just they're not sure exactly where things are going to shake out, so they're kind of pausing their
Yeah, I'm seeing more of
decisions.
what Maggie is seeing. Like I'm seeing more people compare interest rates more than usually I have to like really like pull a first time home buyer to like pre-approve with more than one lender and just to compare and like they are already coming pre-approved with multiple lenders and trying to see so they're just super payment conscious.
Thanks, Temi. You were breaking up a little for me. I'm not sure if that's my connection in general. If it was breaking up for other people, the takeaway from what Temi said is that people are very payment cautious, maybe shopping around a little bit more than they normally are for lenders, where it's just you can tell like when things start to tighten up, every dollar makes sense. Touched on this last month, but it's really important. So I'm going to cover it again really quick. Why is there a disconnect between these GDP numbers and what a lot of people are feeling? And when you dig deeper into the what's happening under the hood, it's really clear why. And so one, it's the economy is really uneven right now. You have high-tech sectors and some of the large states really pushing the economy. I mentioned a few months back chief economist for Moody's said that 22 states in the District of Columbia are already in a recession. So chief economist of Moody's is saying our area is already in a recession. Almost half the country is in a recession, but you have certain sectors and certain geographic areas that are propping up the rest of the economy. And then speaking of propping up, you have massive AI buildup. And by any, I saw some analysis recently that said, oh, AI investment isn't really pushing the economy as much as everyone thinks. It only accounts for a third of GDP, or only accounts for 40%. It's like, well, that's still a lot. So anybody who knows what they're talking about, who's looked into this, will say that AI investment is pushing GDP and in pushing the economy is pushing the economy, and just have some sources in there of what people are saying. And then, as I've said before, so roughly 2/3 of GDP is consumer spending. And the top 10% of households account for 50% of consumer spending. So the affluent are still doing well. They're still spending a lot of money. Talked about there were very few sectors last year that added jobs, but leisure and hospitality were one of them. So you still have people with a lot of money still doing a lot of fun stuff, still pumping a lot of money into the economy, but not all people are. And then when you add to that, what I talked about, the trade deficit, how when you're importing fewer goods, that essentially boosts GDP. So all of that taken together, when you understand it, makes it clear why GDP numbers are great, but it doesn't necessarily feel like the economy is great. Jobs market very shaky as well. So that's another reason. And speaking of shaky jobs market, so looking at our local area, and other Northern Virginia has a lower unemployment rate than the rest of the country, but other than that, DC unemployment rate is 6.7% as of December, 0.2% higher than it was. Oh, thanks, Shelly. Sorry, just mentioning they heard Temi fine. So that's on my end. Hopefully you all can hear me fine and I am not dropping out. Actually, on that note, Temi, can you entertain the folks for just a second? I just realized I forgot to do my hardline connection. We'll edit
Oh
this out later.
yeah. Yeah, excited to hear about the numbers for last month. I'm feeling definitely seeing a surge from for this year as far as more people interested in purchasing a home. Last year, like I think the biggest word for a lot of us last year was just uncertainty. Like that was the biggest thing that we were hearing. I'm not hearing. I mean, there's still some sense of uncertainty, but I'm just not hearing as much of that this year. There's it's like people are kind of some people are now stabilized and so they're ready to make a move. Paul, you back?
I am back.
Okay.
Just waiting for switched over to a hardline connection. Can you hear me all right?
Yep, I can hear you perfectly. We got someone said hearing a lot of agents resound the current political climate isn't helping for their government workers. Yeah. Maggie
Yeah,
says it feels like sentiment may matter. Yeah.
It looks like even with the hardline connection, something is going on with Xfinity and their speeds. So hopefully I'm coming through okay. Might have
Yeah.
a couple hiccups, but okay, going back. So unemployment in DC historically is a little higher than the national average, but it has jumped up a fair amount recently. So you can see we're almost at 7%. DC Maryland combination unemployment rate was 5.1 as of December. That was down from 6.1 in November. So at least that's dropping a little bit, but the drop is driven by what's happening largely in Montgomery County. Montgomery County unemployment is down 1% from November. So, like as I said, DC unemployment still holding steady, getting a little bit worse. Things are improving in Montgomery County. Northern Virginia unemployment is 3.3 as of December, so that's also down. So unemployment is improving a little bit from where it was a couple months ago, but it is 1.1% higher. That's a 50% increase in unemployment in Northern Virginia. So overall, relatively low levels, but from where it was, it's half again is higher. And then here we just have some numbers that I included before, just to put some specific stats if people weren't here last month into like the sheer magnitude of the drop in federal employees. And also, it's not just federal; it's federal adjacent. We've had a drop in tech workers in the area as well. This puts it into a chart. So this isn't updated with the most recent months, but you can see basically when the current administration came into play, our local unemployment area for the region, not for DC is always a bit higher, for the region was right around where it was nationally. And since then, we have popped up. Okay, consumer price index, 1 month increase was 2%, largely driven by increases in costs of shelter, and food prices also increased. You had the 12-month change. January, all items was at 2.4%, which is great if you believe the numbers. It's the lowest annual change since May when tariffs started to have an impact. And it's tied for the second lowest all items 12-month in the last few years. But it's not as great as it sounds for two reasons. One is different cell imputation, the number of guesses, which we're going to talk about in a second. And the other is that the monthly and the 12-month all items was brought down by gasoline prices. And those, like when you look at what's causing an impact in the consumer price index, not to get too far in the weeds, but I think this is relatively important. Feel free to tell me if I'm wrong in the comments. But so gas prices are bringing down these numbers, and gas prices don't reflect larger prices as a whole for three reasons. One, the US right now is producing record level oil production. And so a lot of more production going in. OPEC has increased production, and then global demand has softened. Like it kind of softened in general, but then also during the winter, there's also always less demand for gas. People are driving less. It's cold. So those factors are what are dropping gasoline prices, not any larger thing related to inflationary pressure. So that's a big reason. And then also the PCE, Personal Consumption Expenditures Index. And this is what the Federal Reserve looks at more closely than the CPI when they are adjusting their federal funds rate. So after the CPI numbers came out, Goldman Sachs did an analysis, and their analysis was that they project the PCE numbers are going to come out in another week and a half, 2 weeks. And they think the PCE is going to come in above 3% at 3.05%. So that's above market expectations. And if it hits that, that's not a good sign, because that'll be the highest PCE in almost 3 years. So these CPI numbers, which seem good, and they're one of the reasons why mortgage rates dropped back down recently, they're really questionable. And I've been talking about this for a few months now because it's been a problem for a few months now. It's like, how accurate is the CPI data? And in my opinion, the answer is not very accurate. You can look here. Might be too small for some of you to see, but the brighter blue in the bottom is different cell imputation. So different cell imputation is you have these enumerators go out from the Bureau of Labor Statistics. They go out and they actually manually check prices, physically check prices on things, specific things. So if they can't find a specific item, then there is an imputation, an educated guess done from either the exact same item somewhere else in the country and they make an adjustment for geography, or they find something that's kind of the same, and then they impute the price from there. There's been a shortage, hiring freeze. There aren't enough enumerators to do this work. And so these educated guesses have been cropping up. You can see this past month, 38% of the data that goes into the CPI was this different cell imputation, educated guesses. And prior to recent months, the number was always 10% or lower. So you had 90% of the CPI was based upon actual data, 10% or less based on guesses. In recent history, we're getting close to 50%. Close to half of the data that goes in the CPI is guesses. So like How accurate is that going to be? And then I don't want to be cynical, but the head of the Bureau of Labor Statistics was fired not too long ago because the administration didn't love the numbers coming out of the BLS. And now there doesn't seem to be any real impetus at making these numbers more accurate. And so when you're using a human influenced assessment piece or an adjustment piece to impute prices that you didn't actually get, and there's all this pressure to make the numbers sound a little better than they are, and then you have another metric which doesn't rely, so the PCE, not to go into the weeds, but the PCE, it relies on comprehensive and aggregate kind of business and administrative data, so it's not susceptible to this. It has its own faults, but it's not susceptible to this kind of error. And when you have that metric coming in much higher, kind of makes you question the reliability of this data. Okay, jobs market. So does anyone follow this stuff? I mean, for me, like when the jobs report comes out, it's like, whoa, that's big news. Does this get on anyone else's radar? Okay, want to cover Mark's question. So 38% of the prices were imputed, and it's essentially yes. So when you have they have specific items. I mean, this is just, can you imagine the enormity of the scale of this endeavor? I mean, we're talking just I don't even know the numbers of enumerators. I would assume it has to be hundreds, if not thousands. But they literally are tasked with going out, finding a specific item in a specific area, and if they can't find it, then they either, so it's like, let's say if you're looking for, brand X of jeans and you can't find brand X, but you find brand Y. So they say, well, this is the price of brand Y. Usually there's this much of a difference between the two, so it'll be adjusted. It doesn't have, the enumerator doesn't do the adjustment of that. That's done like at a higher algorithmic level. Or it's like they just can't find the thing at all, but you're looking for the thing in DC, you can't find it, but you can find the thing in New York. You make an adjustment based upon geography. And so that's what it is. And it's not necessarily as basic as you can't find it. It's like I said, there's been a hiring freeze and there's a massive shortage of enumerators. So they just don't have the manpower to do the job. And no surprise then, like if you don't have enough people to do the work, 40% of the work doesn't get done. And that's kind of where it's at. Okay, jobs market. Temi, you were about to say, what does the jobs market mean to you? Do people pay attention to this stuff? The reason I ask is just like it informs how much detail to go into.
I don't know. Like it's not like the jobs market doesn't come up in typical conversations for me. But
Okay,
so I only pay attention to it when you talk about it, but I see how it impacts everything else. Like that's really the biggest thing. I see when you talk about it, see how it impacts everything. Yeah.
that's fair. Thank you. And as Maggie said, yeah, and PCE comes in hot. Yeah, it actually, there's a lot of things that can create volatility and kind of more impactful, but that's also going to influence the Federal Reserve's decision, which is why, like, I don't expect to see rate cuts anytime soon. Okay, so for anyone who's been following the headlines about the jobs report, jobs came in hot, 130,000 workers net added in January, which is massive, more than double economists' expectations. And you might think, wait, Paul, I thought you've been saying that the jobs market is soft. This isn't soft. You must be a liar or you must be mistaken. And I want to let you know why that isn't the case. This number means nothing. It means nothing. Like that number in my mind is irrelevant. And the reason I say that is it's multifold. One, more than half of the gain, 80,000 of those jobs was in healthcare. If you remember a couple of months ago, I talked about signs that the economy is faltering. And one of the signs is when you have a lot of money pouring into defensive sectors. Defensive sectors are sectors of the economy that do well, regardless of how the economy is doing. Health is one of the core defensive sectors. The health industry does well regardless of what's going on. And that's why last year, like most of the jobs that were added were coming from healthcare. So 80,000 of those jobs were from healthcare. 42,000 of those jobs were from social assistance. So 122,000 of the 130,000 jobs were from a defensive sector and a sector that is tasked with helping people in need. So that doesn't scream to me that the jobs market is very vibrant. And yeah, Darren mentions that Fed Chair Powell said the jobs numbers were most likely off by a fair amount in the past 6 to 8 months. And yeah, by any account, that's true. And that's something good timing there, Darren, because that's something I was just about to go into. So not only are these jobs basically from healthcare, defensive sector, and social assistance, meaning we need more people to help people in need, not reflecting a vibrant job market, but additionally, jobs from 2024 and 2025 were downwardly revised. I already talked about how the jobs market had been incredibly soft in these years. Jobs added from 2024 were revised downward from 2 million to 1.5 million. 2025 revised from 584 to 181. And so the jobs market was already looking weak, and it's looking even weaker. Unemployment rate is 4.3. Take that for what it's worth, which I would say is not a lot, because I think the jobs market is really fragile right now. Employees are still in kind of low hire, low fire mode. So you're not seeing a ton of layoffs, even though you're seeing more of them in tech. But there's just so much going on. I ran through before. It's like, you saw like not only did last year have the lowest job growth since 2003 outside of the two most recent recessions. That was before they downwardly revised and took away 75% of the supposed gains. Then average hours worked for hourly employees was declining. Temp services lost jobs. A lot of people stuck in long-term unemployment. So there's just a lot of uncertainty in the jobs market. And why is this important? Well, it's important because the jobs market is usually like the biggest buffer against a recession. If you have a vibrant jobs market, that means employers can't really cut wages, because if they did, their employees could just go elsewhere. But then also, if you have a lot of people employed, then even when other segments of the economy are faltering, they're still pushing money into the economy. And I talked about how GDP is 2/3, 70% consumer spending. So when we have this precarious jobs market, what it means basically is that I think an economist for KPMG mentioned recently that right now the economy, it's like you're sitting on a one-legged stool. And so you're sitting there, you're all comfortable, everything's fine, but it's a little precarious. And if just a little bit goes wrong, you could see a lot of negativity in the economy, the jobs market tanking pretty quickly. Okay, Federal Reserve, and not a whole lot exciting right now with the Federal Reserve. The last meeting in January, they kept rates unchanged. They're meeting again March 17th and 18th. They appears their hold rate steady again. And the calculus here is the same thing it's always been. Really, the two most important things are the jobs market and inflation. And so whichever one they think is more of a problem will guide where they're at here. Since the jobs market is holding steady and inflation, at least PCE, looks to be problematic, don't see them dropping rates. More importantly, is just to follow along what's going on with Trump v. Cook and the criminal investigation of Chairman Powell. That's the kind of the administration trying to take away the independence of the Federal Reserve. If that were to happen, you would have cataclysmic, like just a cacophony of negative effects throughout the U.S. economy and the world economy. Touched on them last month. We'll not touch on again because we need to get to real estate data. The 10-year Treasury had dropped. It was down from 4.3 when we met last month, which makes sense. Mortgage rates dropped also. Retail sales. So retail sales, this is an indication of like, oh, okay, this is a little troubling. You had retail sales even from November into December, prime holiday season. You would normally expect a bump. That's what the market expected. You didn't have that. So it'll be interesting to see where January comes in. And by the way, that's not a typo. It is December. We're lagging on a lot of data still. So there is no January data yet. All that's been released is for December. Manufacturing, though, was a surprise. Industrial production and manufacturing had the biggest gains in almost a year. Industrial was up 0.7%, third straight month of increased output, beating market expectations. Manufacturing rose by 0.6%, which also exceeded market expectations. Okay, now let's find out what is happening in the DMV real estate market. And since we have more people on than at the very start of the show, I would love to hear in the comments, please, if anyone had, and this includes like Mark, if you had this happen with any of your deals, or I'm not sure if we have Katie or anyone from Title on here or any of the agents, if you had a deal, either seller or buyer client that was under contract at some point in December, supposed to close in January, and then didn't close in January, if you could drop in the comments why, and you can be as generic as possible to protect confidential information if there is any. But I'd just like to know why, and I'll tell you why in just a second, because there's some weird stuff going on. But how are people feeling? What's been going on? Like, what are people seeing on the ground? Are we seeing a lot of competition for listings and not much competition? Any changes from what had been happening the prior month? The
For me, it
this
was
is
just So
Go
I was
ahead.
gonna answer. Yeah, I was gonna say for me it
Mm.
was just home inspection stuff. Like I
Did
think
did you have?
I've seen it a few times between last year, just even last year, and then still going into this year. Um, home inspection issues where the buyer isn't asking for anything; they're just walking away.
Mm, okay, that's interesting.
Mhm.
All right, going into this number is meaningless. Like I just include it because I include it every month. But at the beginning of the year, we've only had 1 month of data, and January was a slow month. So right now we're on track for 44,786 transactions. Excuse me. This would be, excuse me, lower. You can see that the past 2 years we were right around 48,000 transactions. Most people are, including myself, are expecting a more vibrant year, somewhere in the 54,000. So things should pick up. Sorry, I missed a couple of comments. Just going back. Mark is saying home inspection issues for him too. Condo approval, that's always tough. Yeah. So and that kind of matches what my guess was, although my guess is a little more specific that it's kind of you're seeing a lot of issues on home inspection. Okay, now we're going into something that hasn't changed. We had median sales price monthly year over year appreciated by 4.8%. We're now at the 32nd straight month of year over year DMV price appreciation. And this is just one of those things I was saying. Like, if you have buyers on the sideline in most areas who are just waiting for a better deal, they're not going to find it, because even as the market is slowing, we are still seeing appreciation overall. There's some pockets, some neighborhoods where prices are stagnating or even declining a little bit, but overall, 32nd straight month of price appreciation in the DMV. And we've also seen right around 5% now in year over year gains for the fourth straight month after things were tapering off a little bit. And then another thing we've been seeing every month for a while now is an increase in days on market. So 36 days on market, median days on market for January. This is almost 2 weeks higher than last January. And this is the highest median days on market in the DMV in basically 10 years. So the last time median days on market were as high as they were last month was February 2016. So definitely things are changing in the market. It's not entirely clear to what extent. We'll talk more about that. And so this is what I found most interesting out of all the data, and it didn't make sense. Closed sales in January were down 10.3% year over year. The reason why that's really surprising is that last month pendings were only down 1% year over year. And now it's not exactly perfect. If something goes under contract in December, it's going to close in January. Or things in the early part of December that have quick closes, they could close in December. Some stuff that goes under contract late in December, it could have a longer close and normally be expected to close in February. But just excuse me, rough approximation, you look at pendings for the prior month, should give you an insight into where closed transactions are. Great to have you with us, Keith, top producing realtor superstar. Would love to have you chime in, actually, because you work with a ton of clients. We saw, Keith, did you have a lot of deals fall out that were under contract in December and didn't close in January? Because like I was saying, so closed sales down by more than 10%. Pendings were only down by 1% last month. So you wouldn't expect this kind of drop. And just what it means is that a much, much larger amount of properties under contract didn't close than is normal. So my guess, and this is like, I feel like maybe this is a little too specific to have a broader impact, but it's possible. And that's the one thing I've heard on here and elsewhere and experienced also, is that properties went under contract and then fell out on home inspection. And so I was wondering, is it like because of our record cold, so extreme temperatures stress house systems in multiple ways, and an extreme cold really hits it in two major ways, is that a lot of times pipes can burst, and then your HVAC systems tend to go out under extreme stress. That's either when it's really, really cold and the heat is pumping out a lot more, having to work a lot harder than it does, or in the summer when you have incredibly high temperatures and the AC is working. So I was like, Could that have been a large enough problem that was kind of impacting? But regardless,
Or
it's kind
just
of
a
it's crazy.
Yeah, don't forget about the snowstorm that happened. So we had delays in roof inspections. Oh no, that was in February, not January. Sorry about that.
Oh, no, no, the storm was at the end of January, and so that's why, like I do
Oh
think
yeah,
weather
yeah.
absolutely impacted it. So I mean, maybe that's it. Maybe it's just it was the factor of there were more problems. There were some pipes bursting. There were some furnaces going down. But then also maybe a lot of these were just pushed into the next month. I'm not seeing that in the early February data, but we'll talk about that in just a second. So new pendings were up 1.9% in January. I would have expected this number to be higher. According to everything else that's happening in mortgage rates, you would expect this number to be higher, but I do think it was held down by weather, and I think we're going to be seeing more vibrant market, higher transactions later into February and going into March. Okay, new listings down 5% year over year. Kind of not a shock again. I think this is more weather related as well. Like, unless there was an extreme need for a seller to get a property under contract, it wouldn't make sense to be listing it anywhere from mid-January on, because with the storm coming, nobody's going to see a property the weekend of the storm. Nobody could. And then even beforehand, if you go on the week before, you don't go under contract, then you're just kind of sitting there and nobody's going to see it for the following week. All right, active listings up 18% year over year. Kind of same old, same old. We've now had 2 straight years of DMV-wide increases of inventory. The last time we didn't have a monthly year over year increase was January of 2024. Just want to note here, you can see that Bright has changed the way it presents these. It did have active listings on just a single bar going from like 2000 forward, and now they've matched it to how they present the other sets of data, which is these kind of mirrored lines. So you can see where we fall according to past years. This doesn't go back to 2019, though, which is, I consider 2019 the benchmark, the last quote unquote normal year of real estate we've had. And January, we were at 75% of the inventory level of 2019. So we're still very low inventory compared to a normal market. Okay, now there's the repack of all the data. Yeah, and that's a good point, Keith, that buyers do have options. The market is relatively softening, even though we still have kind of not a whole lot of inventory outside of DC. It still is more inventory than we did have. Okay, that's just all the numbers we talked about when you get the deck. Now we are going to jump into county specific data. All right, so here, median sales price. We talked about how overall for the DMV, median sales price was up, but it's not up universally overall. So Alexandria down big, Arlington up big. My personal approach, and just whenever I dig deep into the data, don't ever maybe annualized. If you look at annual appreciation for Arlington and Alexandria, that's a number that's meaningful. Or if you're seeing a specific segment of the market, detached homes in this, that's meaningful. But when you're talking about just general, Temi, are you doing that? When you're talking about appreciation for Arlington and Alexandria, one, there's just not a ton of transactions going on in Arlington County, Alexandria City. And so they tend to get skewed if you have some more lower price condos go up, or more of the expensive new builds that are 2.5 million or higher. So don't take that as real pricing change. So Frederick was up 6%, Loudoun and Montgomery County, Prince George is close to even. And then kind of a big surprise, is that DC median sales price was up by 18.1% in January, and it was up by 14.7% for December, which is a little surprising because this month all property types appreciated, including condos. Condos appreciated last month by more than 10% over the prior year, and row homes were up by more than 30% over the prior year. And that would be kind of nuts, except if you look back, that's, in my opinion, just entirely base effects from where we were at last year. So the median sales price in DC last month was $652, and it was the lowest median sales price since last February. And if you look at January's median sales price of the prior year, it was $553, which is one of the lowest median sales prices of the past decade. And so essentially, we just had a very, very low median sales price in DC in last January, which makes it look like there's more appreciation than there actually is. This is more a reflection, I think, of what was going on last January. So, Keith, when you say this week alone feels like 2021 again, is that you have a lot of buyers jumping back in, looking to kind of getting off the fence, or deciding to buy, or am I misunderstanding? All right. Now, when we look at closed sales, it's closed sales were down big everywhere except Fairfax, which was up 1.4%. Montgomery County up 3.5%. Don't think it's too much time. We're too much into parsing this because it was cold AF last month. So there's a lot of peculiar stuff going on. If you saw this in the actual version, the guy is shivering, so it's a little more impressive than the PDF. But so new pendings, and this is for January, and this is where you see, like, even despite the weather, you had some pretty vibrant markets in some of these areas. New pendings were up. Not only are they up overall, but it's not across the board. So Alexandria was up 6.3%. Arlington was down 13%, which is a little odd. Further out, you get a boost. So you can see that in the areas, it's like you're up 13% in Fairfax, 22% in Frederick, and 16% in Loudoun, basically even in Montgomery County. And then sadly, but not surprising, because buyer demand has been soft in Prince George's County and DC for a bit now. Prince George's is down 6.3 and DC is down 12.3. So I do think the cold affected these numbers because given the kind of slowed market with the government shutdown, low interest rates, all of that kind of like postponed action that I thought would be pushed off into the year, we should be seeing higher buyer demand right now, and I think we will be. And if Keith's comment is what I think it is, it's that we are starting to see that, and the weekly data reflects that as well. Okay, so new listings. You have overall, kind of for those buyers who did want to brave the weather, fewer options. And that's also, it's why we didn't see a higher increase in new pendings, is there were just a lot of people who were holding off listing properties. And so not a lot of options there. New listings are down overall, also down in Loudoun, Montgomery County, down big in DC. I mean, big drop of new listings in DC, but up big in Alexandria, up a little in Arlington, and even in Fairfax, Frederick, and Prince George's. So DC, this is just kind of continuing what's been happening for a little while now. It's like a lot of people are just on pause. Buyers and sellers are on pause. Okay, now active listings is what there are a few things that are pretty much like you can just say generally, and they've been true for a while. And a increase in inventory is one of those things. So continue the trend we've been seeing. Active listings up pretty much everywhere except Loudoun County, which was essentially even, and down 3.6%. So yeah, that's the case, but take it for what it's worth. Because like I've said, an increase in 30, 40, 50% of nothing is still nothing. And outside of the district, there's not meaningful inventory anywhere. And you see these numbers being really low this month. And I think that, again, that's weather and seasonal. You tend not to have a ton of inventory this time of year, and the weather hurt that. So you're seeing less than 2 months of inventory everywhere except Prince George's and DC, and less than a month of inventory in Frederick and Loudoun. DC once again leads the way with almost 4 months of inventory. Now, looking at days on market, and this is, I think weather impacted this as well, but this is a trend we've been seeing. So I think it extends kind of beyond the weather. And this is like just like, buyers having more options, things slowing down a little. This has also been consistent. It's DMV wide and consistent across counties. We've had now 19 straight months of year-over-year increases in median days on market. The last time we didn't have a DMV-wide increase in median days on market was June of 2024. And even then, it was just even over the prior year. So we've been seeing days on market creep up for a while. This is important. If you're listing a property, some properties still go relatively quickly, but it's important to set seller expectations, particularly if those expectations were set in 2020 or 2021 when they were buying the property and in a multiple offer situation, or submitting an offer on the property sight unseen, or before it even hit the market, they saw a sign in the front yard and wrote an offer. Like all of that stuff was going on. If those are their expectations, you need to set the expectations that homes are taking a little longer to sell now. But that's also a great counterpoint. Tom mentions that some buyers think sellers are desperate when they're not. And that's outside of the District of Columbia. Like I said, it's just there's not a lot of inventory. There's not a lot of inventory. And even though days on market are increasing, we should see those numbers drop, not drop year over year, but drop from where they are now from the absolute numbers. And you still have, outside of the district and Prince George's County, I mean, you still have great properties going quickly in both of those, just not as much. But in general, like Northern Virginia in particular, and some other parts where the market's a little more vibrant, if, property is kind of turnkey, checks all the boxes, is nice, something a lot of people like, it'll still go under contract relatively quickly. On that note, I'd love to hear, has anybody had a multiple offer situation within the past month, either on the buy or sell side? If so, please let us know where. Okay, so back to days on market. So already covered how this is the highest DMV-wide days on market in a decade. And this is true for much of the area. So this is the highest number of median days on market in Alexandria in more than a decade. Highest days on market in Arlington in almost a decade, since February of 16. Highest days on market in 7 years for Frederick and Montgomery County, and the highest days on market in more than a decade in DC. And it's not even close. Like, it's not even close. The DC at 58 days on market, the second highest days on market in DC over the past 10 years prior to this was 45. So, like, wow, median days on market beat the record for the past 10 years by almost 2 weeks. So things are slowing down. Again, it was cold. We had a brutal storm. And so I think all of these are higher than they otherwise would be. And it just goes to show you, like here in the showings, you had some people out there braving the cold. And there are also some strange numbers here. So just want to touch on a couple of things. Showings were down almost 11% in Loudoun, but pendings were up 16%. So that's kind of the reverse. And maybe that's also just directly weather. Maybe that's, well, it's miserable outside. I'm afraid to drive on the streets. So buyers who were out there, well, I mean, if you were a buyer that was out there, maybe you were just super committed, and that's where you see the disconnect. But then conversely, kind of showings were up 11% in Prince George's County, but pendings were down 6%. Usually you see a little bit more of a correlation of that. Okay, now jumping into the weekly snapshots. I mentioned at the top that I'm covering the week ending February 1, and because most of this data was included in January's, the monthly data, but I thought it was particularly important to look at this now because this is the week of the storm. And if you want to to clearly see how the storm affected the area, looking at the last week of January into February 1 and the following weeks is really insightful. And yeah, Casey has a good question. It's a really good question. So before I hit the weekly data, we've got a little extra time. So I think in my opinion, it's like what works now is what has always worked. And it's always been my personal approach. And really for most of the listing agents at Fulcrum, this is what we do. When we meet with a client, we'll ask them what their goals are and what their expectations are, what they would like to get out of the sale of their property. And more times than not, it is to net the highest amount of money. They want to walk away with the most money. And usually what that entails is to, if there are glaring problems with the home, fix them, and then maybe brighten up, if some things are dated, maybe brighten up the kitchen and the bathroom. And so here, when you have a market where there's a little less buyer demand, there's some more options. It's like being that home that more buyers will not see flaws in, and more buyers will see everything they kind of wanted. It just increases your chances of success and really helps you even outperform where you might be in a more vibrant market. And so that's why just personally for all of my listings, if the client agrees, I'll do a home inspection just like a buyer would. So that way I know if there are any kind of red flags. I don't want something to come up on the buyer's home inspection that'll blow the deal. And so if there are red flags or just some little things that might be annoying, maybe we take advantage of them beforehand. Maybe we replace the old ugly countertop with some nice cream quartz and kind of get it to that point. And so I think kind of, Casey, to your point, it's like, if that's what the seller wants. Sometimes if they just want, like, I don't want to deal with anything, I just want to sell it as soon as possible. If they're not interested, that's one thing. But if they want the highest net, and then you talk about the path to that, it's usually creating a home that will appeal to the largest segment of buyers. And those are the properties that tend to have multiple offer situations and still get off the market relatively quickly.
Yeah, so yeah, Casey, I agree. agree with Paul. The pre-inspection, I think, especially for older homes, is just remember, like, it's so hard for a seller who lives in their home, who, especially if they're using your stuff daily, they, it's so hard for them to think that there could be anything wrong with their home. Like, usually when I ask a seller, like, for any major defects, they can't think of any. And I really prepare my sellers now for the home inspection. I prepare them for large credits just from what I've seen on the buyer side. I've been able to negotiate some pretty big credits for my buyers for a home inspection. So I have that in my sellers' minds ready to go. So the sellers are not like, but they'll ask me, they're like, what could possibly be wrong with my home? Like, I don't see any, like, they just can't, because people aren't typically getting a home inspection, when they live in their home for 10 years. So pre-inspection helps to kind of counteract that, to help, prep their home. But not every seller will agree to it. And then when they do the home inspection, if a buyer walks away, I typically will ask for a copy of the inspection, but not all buyers agents will give it. So then it helps to just get a pre-inspection ahead of time, especially for older homes.
Mhm. That's a great point, Temi. I can't tell you how many times I've been talking with a seller, potential seller about this, and I'll mention that my recommendation is do a home inspection. I say why, and I always say, like, the downside is if we find something you weren't aware of and it's material and we don't address it, we'll have to disclose it. But then I say, I'm not in the business of trying to hoodwink a buyer. I'm not in the business of trying to, like, pull wool over my eyes and pass on defects. Like, it's not my decision, it's the seller's decision, but usually they're kind of in the same position. So I can't tell you how many times I've talked to a seller and they said, well, do it if you want. There's no reason to. Everything's fine. And then we do the home inspection and then we find something which could have caused major problems at contract ratification or with pre-inspections. We were able to address it and then had a wonderful close to the transaction. And wow, Germantown. Okay. Yeah, and we saw that with the pending data that some of the outer line areas are a little more vibrant than it is closer in. Thanks for sharing that, Casey. Okay, now I'm going to touch on here. This is just look at this. So what do I think is going to happen? So far, like I said, we're on pace for 44 transactions, which would be the lowest number of transactions in the DMV in like forever. Don't think that's going to happen. I still think we're going to outperform last year. I think we're going to have a more vibrant days ahead of us. I think this spring is going to be very vibrant. And when you start to look at the data, you can also glean information showing that. So, and I'm going to be popping back and forth. Hopefully there's not too much lag here. But you look, so the week ending February 1, which encompasses the storm, you can see new pendings were down 20%. New listings were down 25%. Showings were down 27%. Like, not a lot was happening that last week of January. Then you bump into the first week of February, and you can see that, okay, it's like now new pendings were only down 9%, new listings were only down, or new pendings were only down 5%, new listings were only down 9%, and then showings were kind of even. And then you go on to the next week, and it's like, okay, pendings down 3%, listings basically even, and showings were up 7%. So when you look at this progression through here, it's like just the market was kneecapped with that storm. And then also because it stayed so cold, a lot of the roads were still treacherous. So you see a definite slowdown and you see all of this start to creep up. So in whole, it looks like the market took a beating with the weather and now it's growing more vibrant as things warm up and things progress. And so I expect when we see the rest of February's data, we're just going to see this trend continue. And I would be very surprised if we don't see pendings up in February for the month, at least 5% year over year. Like, I'll be really surprised if we don't see that. Just want to add this. This has been in here before, but if anyone missed the past sessions, just want to note that Bright is expecting an 8% increase in total transactions for the year. They're projecting around 54,000 above kind of the 49, which we were at, and a sizable jump over, like I said, the 44 we're on track for right now. Okay, key takeaways, and then we got 1 minute left. We'll stay on for just a second if anyone has questions. So the market is really tricky right now. It's really tricky right now. It's definitely changing, but the question is, like, it's not clear exactly how much it's changing, in what direction, and in why. So what is weather? We talked about that. I think a good chunk was weather. What is temporary government impact? A lot of uncertainty there as well. What is seasonal? And what is more meaningful? In a typical year, You can just take seasonal, and that's what the whole point of monthly year over year is. It helps to isolate the seasonal changes. But now we have so many other things impacting it that it's really hard to parse what is playing a role and in what degree. So just it's important to pay kind of close attention and let your clients know, particularly on the list side, that there's a little more uncertainty. And then just mentioned kind of District of Columbia real estate market is just really slow on both sides right now, both on the listing and the buyer side. So just kind of know that, inform your clients appropriately. If you're a seller or listing agent right now, like know your market. There's a lot of variance between the areas. Casey talks about 10 plus offers in Germantown. Other areas you can put a home on the market and it might sit for more than a month. Overall, days on market are definitely creeping up. And outside of DC and Prince George's County, it's still an incredible time to sell in most of the area. And in DC and Prince George's County, it's not a bad time to sell. It's still like 4 months of inventory. That's not even a buyer's market classically, by classic definition. And so it's not a bad time to sell. It's just not quite as good as some of the other areas. And so it's a little more important to price your property appropriately, set seller expectations, and then also maybe pay a little more attention to condition of the property. And overall, great time to buy. Talking about rates are the lowest they've been at basically in 3 years, and they've been holding steady there. All right. Last thing to say is just thank you all for joining us. There's some of my contact information. If anyone would like a copy of the deck, you can just email me there, paul@fulcrumpg.com, and I can get you on the distribution list. And if you have any questions or comments, reach out. If you haven't already subscribed to the channel, if you want to subscribe, you can watch the replay on there. And bonus, when you're watching the replay, you can do it at 2, 3, 4 times speed, so you don't have to hang out with me for quite as long. Hopefully it's been relatively enjoyable, though. Temi, do you have anything you would like to share with the folks before we break?
Yeah, thank you guys for showing up at such a high level. Love the questions, love the input, love like this is think of this as yes, this is information, but it's almost like a mini mastermind. So because we want to hear what you're going through and what you're seeing like on the streets. It helps other real estate agents. So thank you guys so much for participating at such a high level.
Absolutely. I second that. Sometimes just with the way I have my screens and various accoutrements set up in front of me, it's easy for me to miss some of the comments and I don't see them all. But I loved how vibrant the discussion was today. And it's I can pull all the data in the world, but there's a lot that is just really you can't get at on a granular micro level without wonderful agents and people in the area kind of sharing your personal experiences and what you're seeing. We just can't get at the recency, and we can't get at, like I said, the micro level. So that is wonderful. And if you're watching this on the replay, if you have any questions or things you would like to add, would also love to hear that as far as your experiences in the market right now or concerns you might have. All right. Thank you all very much for joining us. We will see you next month.
All right.